Imagine discovering that nearly $1 trillion vanished from the stock market in less than 10 minutes. Not because of a war, not because of a terrorist attack, and not because of a recession, but because of how modern financial markets actually work behind the scenes. And now, imagine learning that, at the edge of this chaos, there was a single man sitting quietly in a bedroom inside his mother's house in West London, trading with nothing more than a laptop and an internet connection. Because this is not a fictional thriller or a conspiracy theory. This is the true story of the flash crash of 2010 and a trader named Ninder SRA. On a quiet Thursday in the middle of 2010, Ninder SRA was sitting alone in a small bedroom inside his mother's modest home in West London, focused intensely on a laptop screen that was connected directly to the United States stock market, the most powerful and complex financial system in the world. And while the room around him looked completely ordinary, what was happening on his screen was anything but ordinary, because global financial markets that day were already under extreme pressure due to growing fear around the European sovereign debt crisis, especially the rapidly deteriorating situation in Greece, where rising debt, political instability, and fears of default were shaking investor confidence across the globe. Traders everywhere were reacting emotionally to every headline, every rumor, and every sudden price movement, creating violent minute-by-minute swings. And for most people, this kind of volatility meant danger, stress, and losses. But for a small group of highly skilled traders, volatility meant opportunity. And Ninder SRA was one of those traders who had learned how to exploit chaos itself. For hours, he traded E-mini S&P 500 futures financial contracts that allow traders to bet on the future direction of the US stock market using leverage, meaning that even small price movements could generate enormous profits or devastating losses. And by 7:40 p.m. London time, after an intense trading session, Ninder logged off his laptop, having made nearly $1 million in profit in a single day. An almost unbelievable amount for someone trading alone from a bedroom thousands of miles away from Wall Street. At that exact moment, it was 2:40 p.m. in New York City, and from the outside, the trading day looked rough but normal, with markets down only a couple of percentage points. Nothing historic, nothing alarming, just another volatile day in a tense global environment. But then, less than 60 seconds after Ninder logged off, the entire US stock market began to lose control. Television anchors struggled to explain what they were seeing. Professional traders openly admitted confusion. Currency markets moved violently. Liquidity vanished. Panic spread at digital speed. Within just 4 minutes, the US stock market plunged nearly 10%, wiping out close to $1 trillion in market value. Blue-chip stocks collapsed. Prices detached from reality, and trades began executing at absurd values that made no economic sense. This was not a slow crash like 2008. This was instant, brutal, and unprecedented. The event became known as the flash crash of 2010, one of the most violent and mysterious collapses in modern financial history. A crash that exposed the dark side of algorithmic trading, revealed deep structural flaws in global markets, reshaped financial regulation, and eventually led investigators to a trader operating far from Wall Street. To understand how something like this could happen, you have to rewind to the beginning of that trading day on May 6th, 2010, when US markets opened at 9:30 a.m. Eastern Time under a cloud of fear and uncertainty. Overnight developments in Europe had shaken confidence worldwide. Governments were struggling to contain financial instability. Investors were questioning whether another global crisis was about to begin. And this anxiety was clearly visible in the VIX index, often called the fear index, which measures expected market volatility. By early afternoon, the VIX had surged more than 22%, signaling extreme stress, while the S&P 500 index was already down significantly and liquidity across markets was thinning. At 2:32 p.m. Eastern Time, something extraordinary happened when a massive sell order hit the futures market, dumping 75,000 E-mini S&P 500 futures contracts worth approximately $4.1 billion into the system. This was not a normal trade, it was enormous, and the market simply could not absorb it because there were not enough real buyers willing to take the other side. Prices began to fall rapidly. In just 9 minutes, the market dropped 3%, and by 2:45 p.m., losses approached 10%. At the individual stock level, chaos took over, as nearly 2 billion shares were traded in just 20 minutes, with thousands of trades executing at prices more than 60% above or below their previous values. Accenture collapsed from around $40 per share to just 1 cent in seconds, briefly turning a $30 billion company into almost nothing. While at the same time, Apple stock briefly traded at prices as high as $100,000 per share, momentarily valuing the company at an absurd $54 trillion, nearly equivalent to the entire U.S. stock market. 2 trades involving fewer than 9,000 Apple shares that should have been worth roughly $200,000 instead executed for nearly $90 million, clearly showing that the system was breaking in real time. Then, almost as suddenly as it began, the collapse stopped, and by 3:00 p.m. markets had largely recovered, but the damage to trust and confidence was permanent. The entire crash lasted just 36 minutes, but it changed how the world viewed financial markets forever. Regulators, economists, and traders immediately demanded answers, asking what caused this, who was responsible, and whether it could happen again. As investigators analyzed massive amounts of trading data, attention eventually turned toward Ninda SRA, a trader born in 1978 into a working-class British family with no elite education and no powerful institutional backing, whose entry into trading began in the mid-2000s at a firm called Futex, where he learned to trade futures contracts and developed a deep understanding of market mechanics, especially E-mini S and P 500 futures. By the time he left the firm in 2008, he had accumulated around $2 million. And during the global financial crisis, he made a bold bet that governments would intervene to rescue the system. A bet that paid off when markets rebounded, and he turned his $2 million into roughly $15 million. But as markets evolved in 2009, profits became harder to generate because high-frequency trading firms, armed with powerful algorithms, began dominating markets, executing trades in milliseconds, placing and canceling orders faster than humans could react, and draining opportunities from traditional traders. Frustrated, Ninda turned to spoofing and layering, illegal strategies involving placing massive fake orders with no intention of execution in order to manipulate prices. Strategies he automated using custom software that allowed him to create artificial market pressure and profit from predictable price movements. These tactics worked extremely well sometimes, accounting for a significant share of trading volume and adding fuel to already volatile markets, even though later investigations confirmed that he was not actively trading at the exact moment the flash crash began. Official reports later revealed that the immediate trigger of the crash was actually a mutual fund that used a disastrously designed automated sell algorithm programmed to sell based on trading volume without any price limits. A strategy that failed catastrophically in a market dominated by high-frequency traders who inflated volume without providing real liquidity. The algorithm misinterpreted artificial volume as genuine demand, accelerated its selling, and overwhelmed the market in minutes, while arbitrage mechanisms transmitted the collapse from the futures market into the stock market itself, turning a technical failure into a systemic crisis. In the aftermath, regulators uncovered Ninda SRA's spoofing activity, and after years of investigation, he was arrested in 2015, admitted to earning at least $12.8 million through illegal trading practices, cooperated with authorities, and ultimately received a sentence of 1 year of house arrest. The flash crash led to sweeping regulatory changes, including the Dodd-Frank Act, which finally provided a clear legal definition of spoofing and imposed stricter oversight on automated trading, while also exposing uncomfortable truths about modern finance, including the illusion of liquidity, the dangers of poorly designed algorithms, and the extreme interconnectedness of global markets. Even today, the story remains controversial, with many arguing that Ninda SRA was unfairly portrayed as a villain, while similar practices were widespread across Wall Street, especially when compared to the lack of accountability after the global financial crisis. And that leaves us with the most important question of all. Because what happened on May 6, 2010, was not just a historical accident, but a warning about how fragile modern financial markets can be when technology moves faster than regulation and understanding. So do you believe Ninda SRA was truly responsible for the flash crash, or was he simply a product of a deeply flawed system that rewards speed over stability? Let me know what you think in the comments, because real discussion matters. And if stories like this help you understand how global finance actually works beneath the surface, you will probably want to keep an eye on what comes next.